Definition of cost accounting. Cost accounting is establishment of budgets, standard costs, and actual costs of operations, processes, activities, or products, and analysis of various profitability or social use or fund. CIMA, London. Objective of cost accounting: ascertainment of costs, determination of selling price, control of costs, revision of guidelines for management policy. The first important of cost accounting is ascertaining costs and guiding selling price fixation. If selling price bigger than cost, then in order to generate profit. If selling price smaller than cost, it become loss. Facilitating planning. Strategy planning. Strategy planning is a long-term planning. It purchase of long-term asset and expansion of the business. Operation planning. Operation planning is a short-term planning. It is decision making for the availability of resources such as raw material and labors. The third is providing information for short-term and long-term decision making. Short-term decision making: make or buy a particular component, then price for a special order. The fourth is providing information for short-term and long-term decision making. Long-term decision making: pricing of a new product, development of new products. Time dimension. In cost accounting, focus on present and future data. In financial accounting, report on the past to draw up financial statement. Accounting method. In cost accounting, it's not based on double entry system. In financial accounting, it's follow the double entry system.
Today I'm going to explain about the difference between cost accounting and financial accounting about report frequency. The first one will be cost accounting. At cost accounting, the frequency report will be data and statement are prepared whenever noted, for example like monthly, weekly and daily. However, in financial accounting, financial statements are prepared for a defined period of time, usually will be a year. Next, I'm going to explain about format between cost accounting and financial accounting. In cost accounting, there are no specific format. Management decides internally which format must suit the users. However, at financial accounting, the financial statement are prepared in the format prescribed by regularly body. Hi guys, today I'm going to explain 4 types of element of cost. The first one, it will be direct material. Direct material can be measured and charged directly to the cost of the produce. The second one is do not include minor items such as nails, glue, and varnish and more. The example of direct material will be like rubber to make tires, bruise oil to make diesel fuel. Next one will be overhead. Overhead has 3 types. First one is production, administration, and selling and distribution overhead. First, I'm going to explain about production. All production costs other than direct material, direct labor and direct expenses, such as depreciation of machines, maintenance of factory, supervisor salary. The next one will be administration overhead. Costs related to general management, such as secretary and office staff salary, office rental and depreciation as well. The third one will be selling and distribution overhead. That will be cost necessary to secure customer and get the product into the hands of customer. The example will be such as sales commission, advertising, depreciation of delivery equipment and finished goods warehouse. The third one will be direct labor. It also can be identified as specifically and exclusively in producing or providing service. Do not include foreman, supervisor, electrician and more on. The example will be like pilot for airplanes, workers for assembly lines and chef in restaurants. The last one will be direct expenses. Direct expenses are expenses other than direct material or direct labor that are directly incurred on a specific cost and unit. Example should be like royalty paid for recipes, cost of special tool for manufacturing. Thanks.
Cost unit: a quantitative unit of output or service to which cost can be related. Example: per kilowatt hour, per kilogram of material.
Cost center is a location, function, or item of equipment in respect of which cost may be assigned and related to cost unit for control purpose. Example location such as sales department. Other than that, person such as salesman. Cost objective. Any item, product, or activity for which a company wants to ascertain the cost. Example, cost of product providing a service and cost of operating department. Conversion cost. Total cost of direct labor and production overhead. Example, direct labor plus production overhead. Direct labor such as factory labor, cost of operator. Production overhead such as indirect labor, indirect expenses. Opportunity cost. Costs that are sacrificed when the choice of one course of action result in alternative course of action to be foregone. Example, a company has limited machine capacity to produce both its product A and component Z. Besides that, if component Z is produced internally, it will require 3 machine hours. Incremental cost. Additional cost resulting from an additional process or batch of unit produced, known as differential cost. Example, if fixed cost increased as a result of increasing the production capacity, then the difference between original fixed cost and the increased fixed cost are the incremental cost. Replacement cost. Cost incurred as a result of using an existing facility or item that need to be replaced for future use. Example, the replacement cost will be the market price of replacing the stock items. Sink cost related to past expenses which have already been incurred. These costs do not affect future decisions that are considered. Example, project estimation cost, fixed asset cost which have been purchased previously, and stock in the store which have been purchased previously.
First, fixed cost. Fixed cost is cost that remain constant at all level of output and would accrue even if no output was produced. For example, building rental and building insurance. Second, variable cost. Variable cost is cost that change in direct proportion with production activity. Total variable cost increase as activity or number of unit increases. Example, direct material and direct labor. Third, semi-variable cost. Semi-variable cost is cost that contain both fixed and variable costs. For example, telephone costs contain a fixed sum of rental for a period, for a month, and variable costs per metered calls. Product costs. Product costs are costs identified with goods produced or purchased for resale. Example, direct material and direct labor. Period costs. Period costs are costs that are not included for stock valuation purposes. For example, administrative expenses and selling and distribution expenses. Controllable costs. Controllable costs is costs that are targeted for cost reduction by managers. For example, production wastage and production reworks. Non-controllable costs is costs are not targeted for cost reduction. For example, factory rent and factory insurance premium.